All right. Assalamualaikum and very good afternoon. Okay, so for this week, we're going to continue with the risk and return. Okay, so last week I gave you a video, I think, right, for risk and return, but for single security. Okay, so for today, we're going to continue with the still risk and return, but from the perspective of portfolio. Okay. Right. Okay. Okay, still risk and return for portfolio. So here's some background assumptions. Okay, let me check ada record. Okay, so when we do risk and return for portfolio, we need to do some assumptions because that's how it works lah for apa? For economic punya assumption ataupun economic theory. So here, the first one, we need to assume that every investor, okay, every investor wants to maximize the returns for any given level of risk. Okay, meaning everyone will have the same intention. I can see intention, right? To maximize their returns at any given level of risk. If you refer to the video last week, where we did on the expected return, the ER, okay, the ER, we have the probabilities. Okay, last week I used the word best case, normal, and worst case scenario. Okay, and every level will generate different level of risk. So that's assumption number one. Okay, your portfolio includes all of your assets and liabilities, meaning you don't have any other assets than that portfolio. Okay, we cannot assume you have another types of assets which is not part of that portfolio. Okay, so meaning you only have that as your assets and even liabilities. All right, that's assumption lah. Even though in normal case, most of the time, all right, investor will have different kind of assets on top of the portfolio that we are calculating. Okay, but for the sake of this calculation, we need to assume that that's the only asset that they have. All right, so a relationship between returns and returns for assets in the portfolio is important, yes, obviously, and a good portfolio is not simply a collection of individually good investment. Okay, but it's beyond that lah. So we will see afterwards what does it mean by a good portfolio. Okay, reservation, right. So risk averse. Okay, risk averse is a choice between two assets with equal rates of return. And as for risk averse investors, we will try to select the asset with the lower level of risk. Okay, later on when we do portfolio, okay, the reason why we do portfolio in the first place basically is to reduce risk. Okay, to reduce risk. So therefore, when we do a portfolio selection process, if you remember, one of the process is to set up the portfolio. We need to choose assets with the lower level of risk as part of our portfolio, to become what we call as a risk averse investor. Okay, risk averse ni in Malay apa? We try to avoid basically. We try to avoid risk. Okay, obviously, as I said, we cannot eliminate risk 100%. We just try to minimize it as low as possible. Okay, as low as possible. So for example here, okay, many investors purchase insurance, for example, either for life, automobile, health, disability, income, and whatnot. And this is one example of risk management process. Okay, you've learned about risk management before, kan? Investment planning and risk, kan? So, insurance and takaful basically is one of a tool for risk management. Okay, so when we have this, we can eliminate some risk, number one. And for investment point of view, okay, for example, if you look in bond investment, okay, we we talk less about bond investment actually. Okay, but from bonds perspective, okay, one of the criteria or one of the specification of bonds in Malaysia especially, every bond in the country, okay, every bond in the country will need to be rated, okay, rated by rating agency. Okay, bonds need to be rated by rating agency. It must be rated, except for government bond, okay, sovereign bond. But for commercial or for corporate bonds, okay, all of the bonds that needs to be issued must be going through the process of bond ratings. Okay, and who are those yang rates these bonds? This rating agency. So rating agency basically institutions, okay, institutions that will check the healthiness of the bond, okay, in terms of the risk as well. Okay, so again, when we talk about risk from bond investment, how to minimize it by looking at the rating. Okay, so for example, here dia letak the ratings from AAA, AA, A. You learn about bond market last semester kan, under the capital market, right? Capital market. Okay, one of the rating agency in Malaysia, we have FRAM, for example, the rating agency of Malaysia, and their style of ratings, okay, starts from the best AAA, okay, then going down lah, AA, A, then BBB, for example. Then going down some more, BB, B, C, and D at the very bottom. So this is the scale, okay, of the rating agency. So that's why when we talk about the risk classification from AAA to A, it indicates that the lower the score here, the lower the rating, it indicates the higher the risk. Okay, the higher the risk. Okay, kalau they're moving downwards like this lah. Okay, AAA is the best. Obviously, if you invest in bond with AAA, it indicates that will be the best or the most secure, okay, the most secure investment. Whereas moving down the scale, it becomes more risky. Okay, so again, when we do about portfolio, we need to mix and match lah. Okay, because when we talk about risk, dia somehow associate dengan return juga. Okay, it must associate with return. So if we look again in the bond punya section here, even though I said earlier AAA would be the best in terms of security, in terms of risk, however, usually the AAA bond will offer the lowest return. Okay, the lowest return. So the higher return will be somewhere below this scale. Okay, meaning between AAA and BBB, perhaps BBB might offer you higher returns. Okay, but it comes with risk lah. But the risk will be higher at BBB as compared to AAA. Why BBB offers higher returns? Okay, simply because if they offer the same return as AAA, who will buying their bonds? Because people might as well go for AAA punya bond because it's more secure and the returns will be the same. So that's why for BBB punya bonds, in order to attract investor, they have to sell or they have to offer higher returns to the investor. Okay, I will not go into detail in terms of the technical terms, but when we talk about the scaling of this, the rating here, even though, like I said, the AAA is the best in terms of security, but usually they will offer the least return because they don't have to offer higher returns for people to invest because people will invest in their bonds because their bonds are the most secure, the most secure. Okay, so but not all investors are considered as risk averse. This sebenarnya we have 3 level of investor, risk taker, okay, risk taker, risk averse, and the middle one tu apa dia ni? I forgot the name. Risk averse, they're indifferent lah. In the middle tu, they're indifferent. They don't worry too much about the risk. Okay, but obviously they want to get their returns for every ringgit they spend. Okay, but for risk taker, that is considered the most or the highest risk appetite kind of investor. Okay.
Tadi yang tengah-tengah tu neutral.
Something like neutral. Neutral or indifferent. 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 All right, so we move on to the estimations. Okay, so again, when we talk about risk and return, obviously we need to do some measurements lah, ataupun some estimations. And again, we will measure both the return. If you remember last week, the measurement of return, we measure the ER, the expected returns. Okay, and for risk, based on the video, I mentioned about we have variance. And we have standard deviation. Okay, so this was last week. Okay, return, obviously, we have the first part, yang HPR, HPY, and whatnot. So, but like I said, we just focus on the expected return side, the ER. Okay, so last week, we've done this one for individual assets. Okay, but for today, we're going to focus on the portfolio side. Right, and from the portfolio point of view, right, it is equal to the weighted average concept. Okay, remember when we've done or we calculated the ER last time or last week, it depends on probability, and the probability must equals to 1.0 or 100%. Okay, last week I said, let's say we have 3 types of probabilities. Okay, the combination of all 3 must equate to 1.0. Okay, and this is similar concept of weights ataupun weighted average. But for portfolio of investments, so we need to calculate based on the weighted average as well. Okay, so meaning last week we just calculate for stock A or for stock B alone. Right, so for the portfolio investment, what we're going to do, we need to calculate individually first. Okay, we still need to calculate individually. But on top of that, we will combine it, the calculation of ER, expected returns, with this element, the weighted average. So how the weighted average can be found from these calculations? Right, usually when we do the portfolio investment, it will be based on value of assets. Okay, so the weight will be based on the value of assets. Let's say you have 100,000. Let's say you have 100,000 fund. Okay, you have 100,000 of funds, and you have 2 options. You have stock A and you have stock B. So when we talk about the weighted average, we need to identify for stock A and stock B how much is the individual investments. Okay, how much will be the individual investments? For example, you have 100K and you want to diversify. Okay, the nature of portfolio, obviously we need to diversify. So let's say, from this 100,000, you split, for the sake of calculation, 40K in stock A and 60K for stock B. Okay, and to find the weights for each stocks, what we need to do is basically compare the value of that particular investment against the total investment that they invest. So meaning if you want to make it in percentage, kalau 40K with 100K, this is 40%. And 60K over 100K, this would be 60%. So this is the weights I'm talking about. Okay, so based on weighted average, we need to find these weights. Okay, later on, when we do the calculation, I will explain again where we want to find these weights. Okay, but from ER point of view, we need to have this, okay, weighted average. Okay, and where, I repeat, this is based on value of assets. Okay, value of assets. So the question might give you a direct ratio like so, or you have to find the value of those assets in order to find the weights. Okay, when we do the exercise, I will explain again. Okay, so this is the formula for the portfolio return. Okay, the ER for portfolio. So this is the element of weight I mentioned before. Okay, and these R represent the ER for individual assets. Okay, the ER for the individual assets. So let's say most of the time I can assure you, most of the time selalunya we will measure at least two investments. Okay, at least two investments, just like this lah. Stock A and stock B. Okay, so this W, right? Because we need to find the sum, right? So this W be represented like this lah. Kalau ni 40%, and the second one would be 60%. Okay, but we don't have this written for illustration purpose lah. Okay, I'll show you afterwards. So simply multiply between the weights and the returns, and then we sum every layer that you have. So kalau you have two instruments ataupun two investment, you will have two weight A times return A plus weight B times return B. That's it. Okay, example lah. 40% times 11% return. Then you add with second layer of weight, 60% with 14% of returns. Okay, then you will get the expected returns for the whole. Okay, so just two elements, the weights, W is the weights, and the R is actually the expected returns. Okay, based on individual. Okay, remember last week when we do the ER, or I can write it here, it's actually still the sum of, kan? Formula dia the sum of, cuma probability last week with the with the return, not ER, just the expected returns. Not expected return, apa panggil? The required return. Okay, the required return, which is from the question. Then you add all, then you dapat ER. This ER will be represented here visually. Okay, bear with me, tak sure you faham ke tak. Something like this lah. Okay, we will do this afterwards. All right. So we have two stocks here. Okay, 6 AM dengan Mount Clark. All right, and we have three probabilities with the three state of economy, good, normal, and poor. So we have three level of probabilities. So based on last week's, what we need to do, we need to find the individual ER. Okay, ER for 6 AM and ER for ML. Okay, so that's what happened here lah for the first question. Calculate the expected return for each stocks. So this is what we learned last week. Okay, but for today, kita akan expand by calculating the ER, still expected returns, but on the portfolio. And this would be the ratio. Okay, the weight for this question is given here, 40-60. Okay, so this would be the W, but the ER is based on our calculation for the first step. So we will do this later lah, but this is how we do it in terms of finding the expected returns of the portfolio. Okay, so that's it for ER. Okay, for return, still we will measure the ER, but for portfolio. Okay, so now we move on to the risk. Okay, to the risk element. Okay, again, if we recap last week, for individual, we have three measurements. Okay, the variance, symbolized with the sigma squared. We have the standard deviation, okay, symbolized with sigma. So meaning if you want to find standard deviation, what we need to do is to square root our variance. We square root variance to get standard deviation because the symbol is just sigma. Here, this is sigma squared. So to normalize the square, we need to square root. Okay, and the third one was CV, coefficient of variation. So as I said, refer to the previous topic. But for today, okay, we still will can calculate the variance, the standard deviation, and CV. Yes, we can calculate, but we need additional information because we are calculating more than one securities now. So here we have two additional information we need to find, which is the covariance, symbolized as COV, covariance. So IG here refers to the investment lah. We have two, for example, investment I and investment J, right? And on top of covariance, we have another measurement, okay, which is correlation. Okay, correlation. So the both of covariance and correlation measures the relationship, okay, the relationship between the investments in your portfolio. Let's say again, if you have two investments, just like what the question is all about just now, okay, yang 6AM dengan ML tadi. Covariance and correlation will determine how these two stocks behave one another. Okay, so by having this covariance and correlation punya measurements, we can see how they react when one of the stocks behave. For example, if they have, because when we talk about covariance and correlations, there are three possibilities: positive relationship, okay, negative relationship, or no relationship lah. Okay, or no relationship. So what does it mean? If it's positive relationship, okay, they will move in the same direction. So they are positively related. So meaning if stock A goes up, stock B will goes up as well in terms of the price, for example. Okay, so that's positive. Again, if it's go down, the other stock will go down as well. Okay, so bukan masuk positif dia akan goes up all the way. They will move in the same direction je lah. Up and down. Similar pattern. Okay, but for negative relationship, the second one here, they will go inverse. Okay, in reverse. So meaning if one stock goes up, the other one will go down, and vice versa. Okay, hence the name inverse, terbalik. So negative, it means still we have relationship. They are related, but in a different direction. Okay. And lastly, no relationship at all. So meaning if we measure the covariance or even the correlation and we found that there's no relationship between the two stocks, it means that they move independently. They don't correlate from one to another. Okay. So for a good portfolio, okay, supposedly we need to find, okay, stocks or investment that have a slight or minor negative relationship. Okay, we don't want a positive relationships in our portfolio. Why? Because the reason of portfolio, again, if you remember, is to minimize risk. If it is a positively related investment in our portfolio, it means if goes up, okay lah, but what happens kalau one goes down? Right, one of our investment drop in values. So if it's positive related, the other investment will go down as well. So definitely we will lose money there. So it's defeat the purpose of defeat the purpose of portfolio lah. So that's why the best instruments to have in the portfolio, it should be a slight negative. We don't want a pure negative relationship, sebab kalau a pure dia memang totally the opposite direction kan. So that's also defeat the purpose of portfolio because we dah generate as high as possible returns on one stocks, but the other one kita rugi at the very bottom. No, that's kalau negative, totally negative lah. So that's why we want a slightly negative. Okay, meaning they move in a different direction, but not too extreme. Okay, so that's what we want. Okay, so we need to measure this lah for our portfolio. And this measurement, especially covariance, is important because in order to find the variance and automatically standard deviation, we need to know our covariance. Okay, so covariance, let's look at the covariance. So covariance is a weighted average again of the expected return, or symbolized as R hat here. Okay, and to see their movement between the two or more in the upper securities. So this is an absolute measurement of the degree to which two variables move together, as I mentioned earlier, relative to their individual means values over the time. And move together means they are generally above their means or below their means at the same time. So for us, okay, you can ignore this part, kita tak guna formula ni. We're going to focus on this formula. Okay, something missing kat sini. I think patutnya ada multiply. Ni ada minus kat sini patutnya. Okay, so we use the probability again. Okay, the probability from the questions. And if you remember when we did variance, we want to find the difference between the expected returns dengan the required returns. Similarly, okay, we're going to find the difference between the two. Okay, this is the required return, and this is the ER we calculated based on that individual stocks. Okay, and for, kalau you ingat last week ataupun based on the video, when we want to find variance, the formula was probability, okay, the sum of probability. We multiply with return minus the expected return, and we square. Okay, this was last week to find the variance. Okay, but for the covariance, okay, we don't square, meaning there's a possibility of negative juga lah here. Okay, for covariance, remember, we have three relationships again: positive, negative, and no relationship. So the score of covariance can be positive, can be negative. So if it's positive, it means positive relationship. If you have a negative covariance, it indicates a negative relationship. Okay, so when it would be considered as no relationship, if your covariance equivalent to zero, the exact zero, then it will be a no relationship between the investments. Okay, so you just multiply three items lah. Probability, multiply with the difference for stock A, and then multiply with the difference for stock B. Okay, we have three items here. We're supposed to have some juga lah, since we have three probabilities kan. Okay, so that's how we do it. So as I mentioned earlier, we have positive covariance, whereby they move in the same directions. Right, so if one stock goes up, the others will follow. Same goes if they go down, right? Negative covariance, so it means they move in the different directions, inverse. I said earlier, I used the word inverse. Terbalik, so this is what I said there. If an investor wants to portfolio, try to have a low inverse covariance. Okay, not strong covariance. Slightly low covariance between each other, so that they not move in a totally opposite direction. Yeah, lastly sebenarnya kalau zero tadi if it's zero, it means no relationship at all. If zero, if zero, the score of covariance. So that's the first measurement, covariance. Okay, covariance. Yeah, this is a formula that we need to use later on lah. The sum of probability with the difference of returns for stock A and stock B. So once we have covariance here, we can calculate correlation. Okay, correlation. Okay, so correlation is another form of measurements between two investments. Okay, it measures the degree of relative correlation, symbolized with P here. And here we can see the strength, okay, the relationship between the two variables. So, patutnya P tadi I don't know why dia hilang the font. Okay, the measurement, the formula is based on covariance. So we have to calculate the covariance first, okay, based on the earlier formula. Okay, and we divide with, okay, what symbol is this? This is sigma, okay? Sigma. So sigma stands for variance or standard deviation.
Standard deviation.
So this is based on standard deviation 1 times with standard deviation for the second stop. All right, so that's why when we do risk and return, first of all, we need to calculate the risk and return for the individual stocks first. Once we have ER, we have variance, we have standard deviation for individual stocks, then we need to use that as part of our risk and return for the portfolio. So because we need that information, for example, just now, for ER, for ER portfolio, we need, besides weights, we need the individual expected returns, ER. And on top of that, just now, for correlation, besides covariance that we need to calculate based on the covariance calculated earlier, we need to know the standard deviation for individual stocks as well. Okay. And for covariance, the score can be huge. The number can be any numbers, right? For covariance, from positive to negative. But for correlation, your score will be for this range only, between -1 to +1. So the number is very limited. So 0 will be in the middle. So it will be -1 here, +1 here. So it means your answer should be between negative 0.99, maybe negative 0.72 or 1 sampai 1 maximum lah, 0.47 for example. So the number is more within the range of -1 to +1. But for covariance earlier, it can be hundreds numbers there. Besar, the number can be huge. Okay. But the explanation is still the same. Okay, because we have positive, we have negative. So if it's positive, it indicates that it is a positively related stocks. And negative is the same thing. It means they're negatively related. So if the two stocks correlation is 0, exactly 0, then we can assume that there will be no relationship. Okay. So towards the extreme part, it will be strongly relationship lah. If it's kalau kat sini exactly here or exactly here the score, it shows that it is a strongly related between the two. As I said tadi, for portfolio, we need to find somewhere around here, around this range. Okay, to have a negative ataupun low negatively related between the two. So the same explanation tadi lah. I don't know why there's other missing. Okay, if exactly +1 is a perfect, okay, perfect positive, 0 no relationship, and -1 is a perfect negative relationship. Right. Okay, so this is another measurement of risk as well, beta coefficient, or simply B, as cuma ni this is a Greek punya B lah. So beta is the covariance measurement that describes how the expected returns of one asset correlated with the returns of the market. Okay. Mention, yeah. Okay, when we talk about risk, maybe I skip last week openly. When we talk about risk, we have two types of risk. Kita ada systematic risk and we have unsystematic risk. Okay, so for the unsystematic risk, we can reduce the risk by diversification. Okay, for unsystematic risk, we can reduce it by doing diversification. So that's why when we do diversification just now, you can see this unsystematic risk will go down. So how to measure? This is where we have variance, we have standard deviation just now, as the standard deviation. So this is measurement for unsystematic risk. But on top of this unsystematic risk, we have another types of risk, which is the systematic risk. Okay, the systematic risk. This systematic risk cannot be diversified. Okay, so how good you diversify pun, in your portfolio, you dah buat all the calculations, you choose the stocks, okay, you can reduce the variance and standard deviation. However, we cannot reduce this systematic risk, and this systematic risk can be measured using beta. Okay, it cannot be diversified. Okay, so for beta, okay, the formula is the covariance. Okay, the covariance. But this covariance is different from what we've done earlier. Okay, just bear with me 1 second. If you look here, the covariance is between I and J. So I and J represents two different investments. Okay, if we have, okay, yeah, when I said covariance of I and J is basically covariance between stock A versus stock B. Okay, so that's covariance IJ. Okay, but for beta, okay, the formula is covariance of I, meaning stock number one, ataupun the first stock, but with M. M represents market. Ini market the market punya score. It's not between two stocks, but it's between stock A and the market, and then we have another part, covariance from stock B with the market. Okay, so this is a different thing. Okay, again, this might not be us in this part, but kita akan recap balik this obviously when we go towards future topics. In the future topics, there's be one part that we need to calculate the beta coefficient. Okay, and again, this is variance. Variance for markets. Okay, M ni represent market. Represent market. So basically, when we talk about beta, this is the relationship between one stock with the market. Okay, the risk factor between that particular stock against the market. It's not between two stocks, but between the stocks and the market. Okay, but the score, we can read it similarly as the previous covariance. We have a zero, which is no relationship, positive and also negative. But we compare the assets against the market, okay, not between two assets. Okay. Right, so this is formula for variance. Dia faham tak ni? Saya nak baca ni. Right, so this is the formula for the variance. Okay, for the variance. I pun nak try to recall balik how to calculate ni. Okay. So I can divide this covariance in three parts. Okay, three parts maybe. Let me see. There's something wrong with the formula. Yep. Okay. So the variance, we still use the symbol sigma squared for the variance. Right. So the sum of, so again, if you have multiple, but usually we will have two layers lah, two layers. The first layer will be our first stocks. So we need to know the weight. Okay, you remember if when we did the weighted average for ER, we have 40-60 tadi. So we have the first weights, let's say 40%. Squared. Okay. The weight squared. near the first stocks near weight squared, multiply with, when we say sigma squared, so this is our variance for stock number 1. So we multiply weight squared with variance, okay, variance. Okay, and then we plus with the second weight, which is, let's say 60%, squared with the variance. Okay, and then we plus with, maybe like what I explain with no figures pun, it's quite complicated here. So maybe we reverse, okay, we reverse balik to make things easier. Okay, so let's try do this together. Okay, I use this as example, right? Bear with me 1 second. Kejap, Okay. Okay. So we're going to do the question 1 together here. Okay, so we have 3 probabilities, as I said. Okay, 70, 20, and 10%. So total equates to 1.0 or 100% kat sini. We have 3 levels of returns depending on the state of economy. Right? So 6 AM and also ML. So the first question, right? So only for question 1. Right? First, they ask to calculate the expected returns. Okay, and together with the standard deviation for each stocks. So we have 6AM and ML. So we go for ER first. We calculate ER, expected returns. For S, delta S represents 6AM. Okay, 6AM. So this is based on last week's formula. Based on last week's formula. To find the expected returns, basically multiply the probability with the required returns. Just multiply, and then we sum all 3 levels, meaning it's 70% first times with 5%. Okay. Plus 20%, the second level, 20%, multiply with 12%, okay, the second returns. And lastly, 10%, 0.1, 10% with 20%. So grab your calculator. So it's 5 plus 2 times 12%, 0.1, 20%. So we have a 7.9%. So this is the ER, the expected returns for 6AM. Okay, the ER or S or 6AM, 7.9%. Okay, ingat, this is just based on last week's punya exercise, or not exercise lah, meaning last week's punya lecture. Okay, so we got here 7.9%. Next, we calculate ER, expected return, for M. Okay, mock like ni. So similarly, we have similar probability, 0.7, but with a different returns. So 0.7 with 40%, 0.2 with 25%, right? And 10% with 7% return. Similar, grab your calculator and calculate. 0.7% plus 0.2, 5% plus 0.1, 7%. So dapat apa? 3.7. If you have difference, let me know Mana tahu I salah kira. So, okay, 33.7%. So we've done our ER, expected returns, for each stocks. So for S and for M, dah ada the answer for both S and M. Okay, 60M and ML. Next, we have to find the standard deviation. Okay, again for each stocks S and M. If you recall again, in order to find standard deviation, okay, yang sigma, we need to find variance first. Okay, so therefore, we have to find variance dulu. So find variance for S. Okay, variance for stock 6AM. Okay, and the formula would be probability. I wrote just now juga. Probability multiply with the difference between returns square. Okay, meaning it's 70% multiply with, okay, ada kan I tulis ni? Ni. Bukan. Okay. The returns and the ER squared. Okay, ya, ada soalan ni tadi. So for 6AM, it's 5% minus 7.9 square plus 0.2, 5%, sorry, 5%. 12% minus 7.9 squared plus 0.1, 20% minus 7.9 squared. Find the total. Okay, so I recap. Probability multiply with the difference of two rates. So the front part here will be the required returns, 5, 12, and 20, based on respective level of probability. And we will minus with the ER. ER mana dapat is based on our first calculation. So if, let's say your ER for S ni salah, automatically your variance will be wrong as well. So please be careful when we calculate the ER, the expected returns. Okay, tolong calculate that. Calculate the bracket first, obviously you know, and mathematically calculate the brackets, 5 minus 7.9, you get a negative square. Why we square, as I said, is to remove the negative sign. That's why we square. Then multiply with 0.7, and then add together with the second layer and also the third layer, then to get the variance. Okay, variance should be positive. Okay, the variance should be positive. Nampak tak? Exactly 24. 24.0. Cannot see. So I see betul lah kalau ada different answer. I tak kira ni. 4 eh. Any other answers? Kalau nak dispute, if anybody want to dispute. Okay, lebih kurang. I got 23.89. Okay, because I use the old figures lah, tapi acceptable lah 24 because I get 23.89. So okay. So we use
So
24.
nombor dia kita boleh je ke round off ke tak
Yeah.
boleh?
Depends on how you calculate. Best if you can keep the decimal. If you can keep decimal. I use, because the answer tadi 3 decimal, I just keep all 3 decimals throughout my calculations. So at the end I get 23.89. But 24 is still acceptable lah, like I said. But maybe nanti the answer will be slightly different lah, slightly different. Okay. So that's variance for S. For standard deviation, simply square root 24 lah. Dapat apa? Dapat 4.89. Ni kalau guna 23.89 lah. Kalau 24 berapa lah? Dapat about 4.9 kan? Tak apalah, lebih kurang. So I use 4.9 je lah. Okay, 4.9. Alright. For standard deviation, you can actually put a percentage here. Sebab dia memang 4.9%. Tapi for variance, this is not percentage. The percentage kalau nak cari percentage, because we use calculator biasa. So this should be 0.00something%. Okay, so just leave it as 24 lah. But for standard deviation, this is percent, 4.9%. You want to put percentage kat sini lah. Okay, but for variance, this is not a percentage. Okay, so just leave it 24.0 for variance. Okay. And that's standard deviation for S. Now try calculate standard deviation for M, ML. Can you calculate that? For variance for M. Okay, similar approach, similar formula. It's supposed to be 0.7, 40 minus our ER for tadi berapa? 33.7. squared plus 0.25%, 33.7% squared plus 0.17%, 33.7% squared. Find the total. Dapat tak? 114.21. Betul ke? Yang lain? Tak kira ni. Okay, setuju Tak ada dispute. Everyone agree? 114.1. Okay. So for standard deviation, M So it will be square root of 114.1. So dapat tadi berapa? Check ni.
10.687.
10 point.
Jangan result. 10.68690.
We keep it 2 decimal je lah. 10.69. Maximum 2 decimal. Okay, so that's the standard deviation for ML. So technically we've done question 1.1. Okay, the ER already calculated earlier. Then we have the standard deviation. Okay, the standard deviation.
So macam this form of calculation ni dapat 10 marks terus ke sir?
Yeah, the 10 marks tu kalau you want to know lah. The ER will be 2 each. Okay, and the variance ni dengan standard deviation be 3 each, 3 marks each. Right, so that's the first part. And again, for the first question is basically what we've learned last week. Okay, so now let's move on to number 2. To find the covariance and the correlation between the two shares. So obviously we need to calculate the covariance first, then we can calculate the correlation, because to calculate correlation we need to have the covariance punya figure. This part tadi So this covariance, okay, is quite similar like we want to find variance. Okay, ini we have 3 levels, but instead of we square, right, we have to multiply between the two. Okay, between the two, because we have 2 stocks tadi kan. So for example, to find covariance, covariance between, this case is between S dengan M lah. In the notes, between I and J, right? So here is between stock S and stock M. Okay, and M here not represents market, M here represents the share, the ML ni. Okay, kalau tak nak confuse, letak ML. Right, so it's probability 0.7. Okay, multiply with the difference. Okay, the difference between number 1, it's 5% minus 7.9. Multiply with 40% minus 33.7%. Okay, so tengok 0.7, we have this first one. Variance tadi kan kita multiply, we minus 5 and 7.9. And for M, the 70% is between 40 and 33.7. So we multiply all 3 items here. And remember, for covariance, we don't square. Okay, we don't square. Just multiply every items, because there's a possibility of negative, I said, we might have a negative covariance. Then we plus with 0.2. It's 12% minus 7.9. And 25% minus 33.7. Okay, and plus with 0.1. It's 20% minus 7.9. And 7% minus 33.7. Then find me the total. Dapat tak? Negative 52.23. Okay. 52 apa tadi? 3. Okay, so that's the covariance. Any other answers? Okay, ke? Alright, again, similar like variance, this is not percentage. This is not percentage. But actually, if you want to write in percentage, for example, even for variance or even covariance, if you want to write, but nanti kalau tak, you confused pula. Just for the sake of writing in percentage, for variance, you need to divide by 100. Usually we multiply 200 to get percentage, but for variance, we need to divide by 100. So meaning here, kalau divide by 100, it will be 0.24%. Okay. But when we want to calculate the standard deviation, we still use the 24 instead of 0.24. So that's why, yeah, better just leave it at 24 lah. Tapi if you want to know how to get the percentage, you need just to divide by 100. So here, be about 1.14%. Okay. And here together lah, you can get or negative 0.052%. All right. So what does it mean here? The two stocks, 6 and ML, has a negative relationship. A negative relationship lah between the two. So it actually can be seen here. Okay. Before we calculate, we can make an educated guess that it indicates this is a negatively related because one shares goes up, for example, ML, the better the economy, the higher the rates. But for this, the poorer the economy, then the higher their rate. So it's inverse, the negatively related. Okay, so it proven with our calculations. It's a negative covariance. Okay, and the question asks us to find the correlation as well, correlation between S and ML. And for correlation, okay, correlation, the formula is covariance divided by this one. Covariance divided by sigma S and sigma ML. Okay, which is when we talk about sigma, this is standard deviation. Okay, so standard deviation 24 multiply with 14.1. Standard deviation kita nak kira tadi Bear with me, salah tulis. Right, so it's standard deviation. So standard deviation is 4.9. With 10.69. So you get a negative. It's almost 1, 0.997. Okay, negative 0.997. So if you want to round up, it's basically negative 1. So this is in an example of a strong or perfect negative relationship. Okay, it is a perfect negative relationship because you get here is negative 1. Okay, kalau you ambil actual figure tadi is negative 0.997. Okay, so the correlationship is very strongly related in negative ways. Okay, they are inverse. Okay, they are totally inverse between one to another. Okay, so again, we can see from here already based on this. Okay, but it's proven with our calculations. Okay, before we move on to number 3, okay, any questions? So when we talk about risk and return for portfolio, obviously, first you need to calculate the risk and return for individual first. Then we calculate the risk and return for the portfolios. Okay. So if there's no questions so far, so let's take a short break. Okay, before we try to answer the third one. Okay, to find the ER. Okay, to find the ER for the portfolio. And obviously to find the standard deviation. So again, if you want to find the standard deviation, we need to calculate the variance of portfolio first. Okay, and for this question, you don't have to worry about the weight, okay, because it's already given here, form of this ratio, 40-60. So we know it's 40% 6 AM and 60% ML. So that's the weight. Okay, and we will use that weight to calculate our ER, number 1, and also for our variance later. Okay. So it's 33.5. So let's take 10 minutes break. So kita akan restart at 3:45. Okay, so let's break. All right. Let's try next one just now. Okay. Okay, so we've done number 1 and number 2. So 16 marks so far. So now let's try number 3. Okay, so the question asks us to find. Tak share lagi. Okay, let's try the next one, which is to find the ER. ER for the portfolio. Okay, when we want to calculate the portfolio part of risk and return, as I said before, we need to know the weight. Okay, the weight. So for this case, the weight is given here. Okay, it's 40 and 60. So meaning weight for 6 AM would be 40%. Okay, and weight for ML 60%. Okay, so how I get this? Because it's here, right? But that's not the case for all time. sometimes you need to find the weights based on the value, just what I've done in the notes just now. Whereby we need to know the total values first of all, and then individual values for each, and then we find the weights individually. Okay, so to find the expected returns of the portfolio, all right. So we have the individual ER earlier, which is this one, 7.9 and 33.7 respectively for S and ML. So what we need to do, just multiply the weights. So meaning it's 40% for WS, weight for 6 AM, and we multiply with 7.9%. Okay, then we add with 60%, 3.7%, and 33.7 for ML. And that's it. That's how you find the expected return or the weighted average between the two stocks. 6.4 times 7.9 plus 6 times 33.7. So the average basically is 23.3%. Okay, simple. This is the expected return combined in the portfolio between 6 AM and ML. Okay, with this 40-60 ratio. So obviously it would be different returns if the weights different, right? But in this case, it's between 40 and 60. So the average would be 23.38%. Okay, now we need to find the variance for the portfolio. Okay, so this is the formula yang tadi lah, the one yang agak complicated. Okay, I amended the formula, not the amended lah. I used the simpler format of the formula. Okay, nanti I reshare balik lah the notes ni. So make it slightly simpler. Okay, the portfolio. And this is where I said I usually split into 3 sections. Ni boleh tak letak bracket ni. Okay, we have 3 parts. Okay, let's go one part, one by one lah. So the first part is actually weight of the first investment square. For example, just now we have the first weight 40% again. So meaning it's 40% square multiply with the when we talk about sigma squared, this is variance. Okay, so variance for stock A. So for this part, we don't have to calculate actually. We just take the variance for the first investment. So that's why we need to know the variance from the first from the first question just now. Okay, so weight for stock A square multiply with the variance of stock A. That's one part. Second, we add with weight for stock B, again square, multiply with variance for stock B. Okay, remember our variance in the first one tadi 24 kan, ini 114 point something tadi. Right, that's the second part. Plus, okay, this is slightly nampak macam long, but it's not that difficult. Plus with 2, so 2 here is permanent ataupun is fixed 2. Okay, plus 2 multiply with weight A without the square. Okay, the first part tadi kita square, but for this part just the first weight, which is 40% for example, multiply with the second weight, okay, 60% for the question, multiply with the covariance. Okay, multiply with the covariance. So this we've done in question number 2 just now. Okay, so there's some explanation at the bottom. Okay, with A and with B would be based on our example just now is 40% and 60%. This is variance for stock A, this is variance for stock B, and this would be the covariance. Okay, covariance between the two investments. Okay, boleh? So let's transfer this into our formula here. Okay, remember we have three parts. Okay, first is weight A, which is in our case A, we assume this is A, this is A, this is B. So our 6 AM, the weight is 40% squared. Right, 40% squared. Multiply with the variance. Apa tadi? It's 24. Okay, 24. Plus, it's 0.6 squared. Multiply with variance for stock B, 114.21. Okay. Then we plus with, okay, this is slightly longer. 2, remember this 2 is fixed, permanent. Multiply with 0.4, which is our first W. Multiply with 0.6, our second W. Multiply with covariance. Our covariance was negative 52.23. You don't forget the negative, so we have negative there. 52 point. Okay, yeah. So the bracket represent negative here. So this is the whole formula for variance. Okay, 0.4 squared, so remember square, times 24, plus 0.6 squared, times 114.21, plus 2, times 0.4, times 0.6, times negative 52.23. Okay, for variance again, we shouldn't get a negative variance. It must be positive. If you get this negative, something wrong with your calculation.
Seven zero point zero
Sorry.
three ke sir?
Semula.
70.02.
Okay. This one. Kalian dapat 93.34. Yang ni betul, ni jawapan sekarang, 93.34. Ini bukan final answer ya, I tulis ya, your answers ni. Apa tadi? Still. 70,000. 70,000 too much kot.
Bukan 70.02 juga.
Okay. Sekejap Let me double count.
Saya
Check.
kira 2 kali dapat jawapan tu juga.
4.95 plus 6. Ada dapat tadi berapa? 19.8852. Yeah. Based on my calculation, 19 tu closer to my answer lah. Yeah. So ada 3 orang dapat jawapan tu. Yeah. So it's 19.86 tadi 885. Okay, sorry. Okay. So for those yang tak dapat, recalculate balik ni 0.4 squared times 624 dapat 3 point something. 0.6 squared times 114 dapat berapa tah? So total ni tadi 44 yang remember lah. This is 44. Then you multiply with this. Sebab this is negative Don't forget You multiply with a negative figure. So you akan dapat quite huge negative amount kat sini. So 44 minus something. So you dapat 19.885.
The number yang dekat dalam bracket yang last kali tu 2 darab 0.4 darab 0.6 multiple by 52
Negative This is negative.
where?
This one. Bracket ni represent negative in mathematics. When we said
Oh,
negative
52 tolak 23 ke tu sir?
point 52.23. This is a negative.
Oh, okay.
Okay, this 52.23 is our covariance tadi Ini. 2.23. Okay, so the standard deviation of portfolio would be a square root of 19.885. So we have 4.46, yes. 4.46%. So for standard deviation, yes, you can use the percentage. As I said, for variance, for covariance, right? This figure is not percentage. So if you want to put in percentage, we have to divide by 100. So like this one, if you want to put it in percentage, you divide by 100. So it's about 0.19%. Okay, but if you don't want to put percentage, just leave it as it is lah. But don't put 19.885% because it is not 19.885%. Just 19.885. Okay, but the standard deviation, yes, you can use this as percentage. Okay, so what can we conclude here? Right. We don't have to comment on the way the question diversify. Okay, but we can look here. The measurement of risk that we want to look at was the standard deviation and also obviously the variance lah. But if we, let's say we just look at the standard deviation. So for the first investment, 6 AM, the standard deviation is 4.9. Okay, for stock B or MOTLAC, the standard deviation is 10.69. Okay, 4.9 and 10.69 individually. Okay, but once they combine, okay, or they do the portfolio, you can see by having some portion as in stock 6am and another portion the stock of ML, okay, which is 4060, we can see that the standard deviation has reduced to 4.46 only. So meaning by having both, okay, with the returns of 23.38%, okay, this portfolio managed to reduce the risk to just 4.46%. Okay, perhaps slightly higher. In fact, lower. Standard deviation is 4.9 tadi, 4.9 dengan 10.69. By having both, we managed to reduce it to 4.5 only. So meaning this exercise of, portfolio or diversification managed to reduce the risk to just 4.5%. Okay, from 4.9 and 10.69 individually. Okay, so basically this is a good, there's a good juga lah, whereby this exercise can reduce the risk. Okay, so that's how you do it for the risk and return. Okay, just nanti I re-upload balik lah kot. Okay, the notes untuk the formula, especially for this part. Okay, so original tadi macam ni, macam mana nak baca ni. Okay, so it's more or less the same actually, but it's more technical this part. You still have the weights, you still have the variance. Okay, there are two parts here with the weights and covariance. Okay, but this is more simplified and easier to read lah. Okay, so I will, you pun dah boleh tengok ni tadi, and in the future, maybe if you can refer to the video, then you can refer to the formula in the video. All right. Right, so I think I'll stop kat situ je for today. Okay, the rest ni you don't have to worry. Okay, you can use this as part of your exercise if you want. Okay, we have two stocks with the three probabilities. In the question, we use three probabilities, right? So we have another question here that you can try with 4 different probabilities. Okay, and yeah. You don't have to worry about the beta yet lah. The systematic risk, the beta ni, you don't have to worry. We will revisit this in the KPM ataupun the capital market theory. So for the risk and return portfolio, I want to stop until there only, right? And as I said, for this topic, there will be a quiz. Cuma quiz tu I akan bagi soalan dia on Thursday. Okay, Thursday nanti lah, Thursday. And I'll give you until the end of weekend lah. Maknanya I'll give you time, let's say until Sunday or Monday. Nanti you just check your My Guru. Right, I will post the question on Thursday. Right, on Thursday. Related to this lah, the risk and return, both individuals and also as a portfolio. Right, so I'll post the question in My Guru and please check lah nanti. Okay, jangan lupa sebab we gonna meet next week Tuesday. So by that time it's already end of the deadline. So the deadline will be either either Sunday or maybe I just put Monday lah kot. Okay, I'll give you from Thursday until Monday before our next meeting. Okay, so be sure check your My Guru lah for the question. All right, any question? Tekan save lah. It's okay. All right, so if there's no questions, I'll stop here. And for next week, going to continue with the economy and the industry analysis. Okay, so for next week, the economy and industry analysis too will be very quick. Okay, I will go through very quick, and we will go straight also after that for topic 5, which is company analysis and valuation. Okay, so we try to look at topic 4 and topic 5, but I don't think we will finish topic 5 next week lah. But partial of topic 5 will be discussed next week. So topic 4 too, very quickly, maybe half an hour or so. Okay, and next we just shoot straight to topic 5. Okay, and so far I've uploaded up until topic 5 lah in my guru. So you have the notes already if you want to refer before our class. Okay, I will upload more notes by the weekend lah. Alright. So again, thank you very much. I have mentioned already the video, the recorded sessions. I dah share dalam my guru in the new place, not in the in the folder anymore. I've shared in the apa nama tu, web conferencing. Okay, I shared with in the web conferencing using YouTube. I uploaded dalam YouTube. You can check the YouTube for you guys. Kalau you, I have 3 classes again for investment portfolio. So every week too, I randomly will choose one video as a public. Maksudnya, I tak publickan every videos. Some videos tu just whoever have the access can access. Meaning you guys I share dalam tu, then you can check lah your videos. But if you go to my channel, apa channel, macam YouTuber channel. But the channel tu, I every week random lah. I A, B and C kan. So from out of 3 ni, I akan make it public satu video aja. So perhaps kalau ada satu lagi video tu from other group, you can check that video jugalah. Alright, if let's say, yeah. And dalam channel tu pun, there's a playlist. I created a playlist on weekly basis according to the topics we've discussed. Then you can check that out as well. Okay, all right. Thanks again. All right, and inshallah, I'll see you guys next week.
Thank you, sir.
Thank you, sir. Assalamualaikum.
Thank you, sir. Assalamualaikum.
All right, thank you.
Thank you, Pak.